Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Monday. It's the first day of the third week of March. Now, the market's going to open up in about an hour and 9 minutes or so. I'm getting on to a little bit of a late start, but I wanted to see how the market was going to open pre-open, especially in light of all the gyrations with the war and all the attacks over the weekend. And the fact that we had one of the biggest moves in a long, long time. I'll get into it last week, but we had, I think, 4 trading sessions that were up in a row. And Mondays and Tuesdays are usually down days. So it'll be interesting to see how the market carries through over the next few sessions. Very interesting. But so far, things are looking a lot better than they did last week. Now, as you can see here, the S&P is pretty much flat. NASDAQ is down. The Dow's down 80 points. Again, right now, 80 points. Typically, I would say anything below 80 points is non-random, but in light of the fact that the Dow has been moving about 600 points a day, this is about as random can get. This is just very, very subdued price action, especially with the S&P up a quarter, the Dow down 78, the NASDAQ down only 12. This is just randomness. The market doesn't know what to do with itself, which is kind of odd in light of everything we're seeing right now, but not in light of the fact if you look at the bond market. So if you look at the bond market over the last, since December, it's been going straight down. Over the last few sessions, matter of fact, since the stock market has been going higher nonstop, breaking 4-day records, the bond market looks like it's bottomed out. Now, I told you guys a long time ago, the bond market is going to dictate the stock market. That's what dictates stock price movement. And right now, you could see here that we're consolidating, and it actually looks like we can be going a little bit higher, or at least staying in this level. That's very, very important. This tells us that even though the Fed is going to raise rates, the bond market, the long bond, has assimilated that rate hike within its price. And it's actually pushing sideways or possibly higher. Not really too much higher, just a little bit here. But if we do end up going higher, and I think we will go to about the 140 level, we're going to sell bonds. But the point is this: if bonds go higher, that means there's no flight to quality. That means there's not that much fear of the war if bonds go up on their own, not if bonds go up because stocks go down. Because stocks have been going down and bonds haven't been going, they've lost their directional. In this regard right here, I made a note that stocks were going higher or lower and bonds were going down no matter what. That's typically not the case. Typically, bonds go up when stocks go down, and that wasn't the case here. And now we're consolidating, and that's telling me that we may be going the other direction on the bond market. If we go higher on the bond market, that is flight to quality, or the bonds telling us we're done going lower, which means the risk of inflationary pressure via the bond market is going to be reduced. But again, we'll see how that goes. But I'd like to see if this trend continues or if it possibly reverses. But the fact that the bond market stopped going lower means interest rates stopped going higher for the last week, even though the Fed made a change. So that's very, very positive, at least for the time being. Let's see if we can get the bond market to hold. That would be very, very interesting. Now, let's talk a little bit about global economy, and then we'll get into important levels. Global stocks were mixed Monday, and they are mixed right now in the morning after Wall Street's biggest gain in 16 months. Biggest gain in 16 months last week. Folks, do you think the market's about to crash when it has the biggest gain in 16 months? That's a bullish sign. Oil prices gained more than $4 a barrel. I think we may be going up a little bit more on the energy market. Investors watched efforts to mediate a settlement to Russia's attack, which has pushed up oil prices and added uncertainty about global economy. Remember, uncertainty is what drives markets down, and certainty is what drives markets higher. Hong Kong shares traded in China's Eastern Airlines. Major mainland China carrier sank 6.5% shortly after the market closed, after state media reported 132 people aboard crashed into a mountain. And there's no report on survivals. Russia's attack added to investors' unease about the Fed and other central banks withdrawing stimulus that has pushed up share prices. Although the bond, as I said, the bond market's been acting beautifully last few sessions. Really, really well. Russia's attack added investors' unease about the Fed and other central banks withdrawing stimulus that has pushed up share prices. Monday, Disney closed in Shanghai theme park as the city tried to control its biggest COVID flare-up in 2 years. Here we go again. The Southern Business Center in Shenzhen allowed shops and offices to reopen after a weekend closure. They're not going to prevent the spread of COVID by keeping things closed. That's just not going to happen. Energy prices, oil is back at 107 over 100, and internationally at 112, and it looks like oil is on the up and up one more time. Now, as I showed you, the bond market is looking steady. Volatility is looking lower, folks. It's not looking higher. It's looking lower. That's a very, very positive sign, and that's a positive sign that the market is going to recover. We actually have a short position on volatility right now that I want to reverse this morning. And again, if you look at the S&P, if you look at sectors, look at what controlled on Friday. Technology, discretionary, communication services. These are the three most speculative sectors. Let's look at it 5-day. Consumer discretionary, info technology, very, very speculative. On a 1 month, though, things are looking totally different, but they're coming back up here. Now, if you look at my cumulative strength index, energy, utilities, and healthcare are still leading. But, excuse me, consumer staples is falling off. That's a very defensive sector. So we'll have to keep an eye on that. On a 1 month basis, it's also falling off. It's actually all the way down here already, consumer staples. That's a defensive sector. But that means consumer discretionary, which on a 1 month basis is now leading, is moving higher. And I told you to keep an eye on consumer discretionary. But if you look at consumer discretionary, it has gained 0.20, where consumer staples is down 1.13. Now, on a cumulative basis, obviously you're not going to see that. Consumer discretionary has been knocked down on a 3-month and a 6-month basis, but it's still higher on a 1 month basis. So right now, fingers and toes crossed, things are looking better with the sectors, with discretionary sectors. Things are looking a lot better with volatility. Let's look at market momentum. Things are looking a lot better with market momentum. We now have 53% of stocks trading above the 50-day moving average. Look at that. Look at that. That's the biggest move in a very, 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 very long time. So the markets are looking a lot better right now than they looked a week ago. The question is this going to remain? And for that, we have to look at the indices. So let's do that, and I'll give you some levels. And some of our levels, I'm hoping, have been actually breached to the upside. So here we are. Now, I told you to keep an eye on this level, the 342 level on the Dow, and we breached it, and we breached it good. The next level is the 200-day moving average. If we can move above the 200-day moving average, we're going to be in a lot better position, and I think we will within the next couple of weeks. That level is 350, 351. On the SPY, let's take a look. But here's the thing. If we bounce hard off of this level, it's no good. What I'm encouraged about, here's what I'm really encouraged about. Look at the small caps, which have been lagging behind. They are actually making higher lows and are looking a lot better right now. A lot better right now. And I'm hoping that they will pass the 210 level. If they can pass the 210 level, they're going to get really, really bullish. The 210 level on the IWM. We've still got a while to go to the 200-day line. On the SPY, just want to give you the big breakout levels. On the SPY, we're almost at the 200-day. I'm so excited. I'm getting a little really, really happy about this. Here's the two levels you need to know. The 447-ish, and then the next level, the 50-day line, is right near the, and I'm talking about the resistance level here. It's at the 458.62. If we can pass the 200-day line, and if we can pass the 460, we're going to hit all-time highs again. Now let's look on the QQQ. On the QQQ, we're almost at the 50-day moving average right here. Then I'm not really going to be too bullish on this till we pass above the 358-ish level, and then the 200-day moving average, which is at the 369 level, and then the magic number, which is at the 370 level. Now, consumer discretionary. This is the number I want you guys to pay attention to, and I've been telling you guys this number for a while. It's the 200-day moving average. It's the 187, but this really here is the key. It's the 190. I told you guys back on February 9th, nothing good is going to happen with the market till we get above this level. I'm going to say it again. Nothing good is going to happen till we break above this level, which is at the 190.12 level. We got to break above that level, but it happens to be real close to the 187 level where the 200-day line is. But everything is looking better this week. As far as major reports, we've got new home sales. Not huge. Home sales have been fairly steady. Durable goods is going to be huge. Huge, huge, huge. Jobless claims is going to be really, really huge. And the PMI flash is going to be big. The big reports come out on Thursday, so we've got a lot of trading to do till then. Keep your eye on the bond market. Keep your eye on this bond market. Very, very, very important. Let's keep an eye and see if the bond market can rally, right, to the 50-day moving average. And keep your eye, very, very important, keep your eye on the 200-day moving average on the Dow at the 350 or the 35,000 level. If we can go up another 3,000 points, we're going to be golden. Or actually about 2,500 points will be golden. Or on the DIA, the diamond, it's about remember, this is not thousands, it's hundreds. So in here, it's from 3. We need to go from 347.25. We need to break the 350 level. All right, folks, before you go, I've got something very, very important for you. Tomorrow at 1 p.m. Eastern Time, Tuesday, March 22nd at 1 p.m. Eastern Time, I'm going to break down a strategy that'll help investors and traders take a more systematic approach to trading. First, I recommend potential attendees read a free ebook so they can better understand all the information that I'll be giving you guys on Tuesday. In it, I'll talk about my number one mistake traders make that allows Wall Street algorithms to rob them blind. I don't want you guys to be robbed blind. I also reverse engineered the algorithmic system that I used as strategy to show everyone exactly how it works. Literally, step by step, how it works. You have to check this out. Click the link below this video to get access to my ebook and register for tomorrow's Meat and Potatoes class. You don't want to miss this out. Follow the link below. And if you're watching on YouTube, go to the Wealth Press YouTube channel, and there's a link below the video in the descriptor. And tomorrow we're going to talk about the strongest sector, strongest stock, weakest sector, weakest stock. Right now, the bond market is the biggest friend and the biggest risk. Keep your eye on volatility. And keep your eye on the Dow, the 35,000 level. That's the key, 35,000 level. And tomorrow, again, strongest sector, strongest stock, weakest sector, weakest stock. Don't forget to get your free ebook. Follow the link below. Do it now. And send me some love letters. I haven't heard from you in a while. Support@marketgeeks.com. And let me know if I've been calming your fears and keeping you out of trouble. Bye, guys. Have a great, great week.